On Thursday, OpenAI made one of its models 80% cheaper. In the same announcement, it told us exactly how much cheaper the model got to run, 20%. Read those two numbers next to each other, and something does not close. A 20% cost saving does not fund an 80% price cut. Roughly 60 percentage points came from somewhere else, and that somewhere else is the most interesting question in the AI economy right now. Everyone is arguing about whether this is a bubble. Almost nobody is looking at the one number that gets published, tested by the market, and cannot be spun, the price of a token. So today we follow the price. What got cut, what the cut buys, who has to answer it, and what it did to two of the biggest companies on Earth in a single trading day. Start with exactly what changed, because the precision matters. On July 30th, 2026, OpenAI published a post titled Advancing the Price Performance Frontier with GPT-5.6. In it, the price of GPT-5.6 Luna, its fastest and most affordable tier, went from $1 per million input tokens and $6 per million output tokens, down to 20 cents and $1.20. That is an 80% cut on both sides of the meter. For scale, a million output tokens is roughly the length of a long novel. Producing that used to cost $6. As of Thursday, it costs $1.20. The second tier moved too, but far less. GPT 5.6 Terra went from $2.50 and $15 to $2 and $12. That is a 20% cut. And the flagship GPT 5.6 Sol did not move at all. It stays at $5 and $30. So the shape of this is not a general price reduction. It is a targeted one. The cheap end of the stack fell off a cliff, the middle stepped down a stair, and the frontier tier was left exactly where it was. That shape tells you the cut is aimed at a specific competitive problem, not at a general improvement in economics. The developer reaction is worth sampling, because it landed on the same read within minutes. On Hacker News, the OpenAI post drew 278 points and 168 comments. The top comment did not celebrate. It said, and I am paraphrasing closely, that having a most affordable tier which still cost more than GLM 5.2 never made sense in the first place. In other words, the crowd closest to the meter read this as a response, not a gift. One more piece of context that got almost no coverage. 8 days earlier, on July 22nd, OpenAI shipped hard spend limits for API organizations and projects, so an administrator can set a monthly ceiling and start getting errors once it is hit. A company that ships spending caps is a company hearing from customers about bills. Now the part OpenAI actually explained, and it is unusually specific for a pricing post. The company attributed the reduction to two pieces of engineering. First, work on GPU kernels, the low-level code that decides how efficiently a chip executes the math, which it says cut the end-to-end cost of serving the model by 20%. Second, a redesign of speculative decoding, which it says increased token generation efficiency by more than 15%. And there is a detail inside that detail. OpenAI credits the model itself with rewriting and optimizing production code to get there. The system helped make itself cheaper to run. Let me unpack speculative decoding, because it is the single best example of why token prices can fall without the underlying hardware getting any cheaper. Normally, a large model produces one token at a time, and every token costs a full pass through the network. Speculative decoding puts a small, fast model in front. The small model guesses the next several tokens. The big model checks them all in one pass. Every guess that survives the check is a token you got at a fraction of the price. Nothing about the chip changed. The accounting of the work changed. Stack that with sparse mixture of experts routing, where only a slice of the parameters fires per token, and with prompt caching, and you get compounding reductions that have nothing to do with Moore's law. And this is not a one-week phenomenon. The research group Epic AI has tracked what it costs to reach a fixed level of capability over time, and the numbers are hard to believe until you see the method. On a set of PhD-level science questions, the price to match GPT-4's performance fell by a factor of 40 per year. Across 6 benchmarks, the declines range from 9 times to 900 times per year, with a median of 50 times. And when Epic excluded everything before January 2024, that median jumped from 50 to 200 times per year. The rate of decline is itself accelerating. Hold that thought, because it is the frame for everything that follows. So now do the arithmetic that the announcement invites, but does not perform. OpenAI says serving cost fell 20%. It cut Luna's price by 80%. If you hold margin constant, a 20% cost reduction supports a 20% price reduction. That is exactly what happened at the Terra tier, cost down 20, price down 20. Clean. At the Luna tier, the price fell 4 times further than the disclosed saving. That gap is not an accusation of anything. It is simply an unexplained 60 percentage points sitting in public view, in a document the company wrote itself. There are 3 honest explanations, and the available evidence does not let us pick between them. 1. The tier was carrying a fat margin, and the cut simply gives it back. 2. Scale. If volume rises enough, fixed infrastructure spreads thinner, and unit cost falls in ways a kernel-level number would not capture. 3. It is a strategic price, set by what a competitor charges rather than by what it costs to serve. The classic move of a company buying share in a commoditizing market. OpenAI does not publish gross margin per token, so all 3 remain open. What we can say precisely is that the published cost improvement accounts for 1/4 of the published price move. Now put the price cut against the size of the thing it has to pay for. OpenAI confirmed on March 31st of this year that it was generating roughly $2 billion a month, which annualizes to about $24 billion. Against that, Sam Altman has said publicly the company holds roughly $1.4 trillion in data center commitments spread over about 8 years, and told investors last November that the risk of not having enough compute was greater than the risk of having too much. Then in February, CNBC reported OpenAI had told investors it now targets around $600 billion of total compute spend by 2030, well under half the original figure. Cutting price into that structure is a decision with consequences either way. And to be clear, nothing in this video is investment advice. Here is the coordinate that makes the cut legible. Anthropic publishes its rates openly, so we can measure the move exactly. Its cheapest listed model, Claude Haiku 4.5, is $1 per million input tokens and $5 per million output. Luna's new rate of 20 cents and $1.20 undercuts that by 5 to 1 on input and roughly 4 to 1 on output. One step up, Claude Sonnet 5 is running introductory pricing of $2 and $10 through August 31st, after which the standard rate of $3 and $15 takes effect. Terra's new rate of $2 and $12 slots underneath that September number. This is not a coincidence of rounding. It is a price set against a published competitor. But the real pressure is coming from below the paid tier entirely. Versal publishes a production index of what actually flows through its AI gateway, and the July 2026 edition is the clearest picture we have of enterprise behavior. Token volume grew 29% month over month, while spend grew 27%, meaning the average price per token was flat. Open-weight models accounted for 29% of all gateway tokens on under 4% of the spend. In April, that share was 11%. It nearly tripled in 3 months. Roughly 1 in 8 enterprise customers now runs an open-weight model in production. DeepSeek alone was 22.6% of token volume, 3rd overall. And the list prices below explain why. At published rates, GLM 5.2 sits at $1.40 and $4.40. Kimi K3 at $3 and $15. DeepSeek V4 Pro's output rate has been quoted at 87 cents per million. GLM 5.2 reached number 11 by token volume on the Versal Gateway within 2 weeks of its June 16th release. There is a second front too. At its earnings call this week, Microsoft leaned hard on its own MAI model family running on its Maya 200 silicon, claiming 40% better performance per watt, alongside more than 11,000 models offered on its cloud. Satya Nadella's framing was that every customer wants the right model for each task based on quality, latency, cost, and compliance. When the buyer thinks in those four axes, cost is the one that moves fastest. Now the part that makes this a market story, and it happened on the very same day as the price cut. Microsoft and Meta both reported on the evening of July 29th. Microsoft's fourth quarter of fiscal 2026 came in at $90.01 billion of revenue, up 18%, with adjusted earnings of $4.74 against expectations near $4.24. Azure grew 43% and passed $100 billion of annual revenue for the first time. Microsoft 365 Copilot passed 30 million paid seats. And crucially, calendar 2026 capital expenditure guidance came down to about $175 billion, from roughly $190 billion guided in April. Meta's quarter was, on the top line, excellent. Revenue of $60.8 billion, up 28%. And then the cash line. Free cash flow came in at $784 million. Not billion. Million. Capital expenditure was roughly $31 billion in the quarter, against $17 billion in the same quarter a year earlier. And full-year CapEx guidance moved to a range of $130 to $145 billion, lifting the floor by $10 billion in a single quarter. Reporting after the print counted 10 firms cutting their price targets, with Wells Fargo moving from $835 to $640, citing limited visibility into monetizing AI compute beyond advertising. So here is the scoreboard, and all of these are real closing prices for July 30th. Microsoft closed up 15.5%. Meta closed down 7.95%. Same sector, same night, opposite verdicts. Around them, CoreWeave up 21.5%, AMD up 13%, Oracle up 8.3%, Taiwan Semiconductor up 7.6%, NVIDIA up 2.6%, Alphabet down 0.9%, and the Nasdaq up 2.8%. Now widen the window to 1 month, and the picture inverts for almost everyone. CoreWeave down 25.8%, AMD down 16.4%, Taiwan Semiconductor down 15.6%, Oracle down 13%, NVIDIA down 2.5%, the Nasdaq down 4.2%, and Microsoft up 20.9%. The market has stopped trading AI capital spending as one idea. When people reach for a historical comparison here, they almost always reach for the equity side of 1999, the valuations, the IPOs, the companies with no revenue. That comparison is about price-to-earnings ratios. But the thing we have just described is not a valuation story. It is a capacity story with collapsing unit prices. And for that, the far closer historical fit is not the dot-coms at all. It is the fiber optic build that happened underneath them, in the same years, funded by the same enthusiasm, and remembered by almost nobody outside the telecom industry. The numbers still land hard. Telecom capital spending peaked around $120 billion in the year 2000, which is on the order of $200 billion in today's money, with cumulative investment well over $500 billion and roughly $800 billion of merger activity in 1999 alone. Carriers laid tens of millions of miles of cable. And then the demand did not arrive on schedule. By 2002, according to figures reported at the time, only about 2.7% of the installed fiber was actually lit. Prices for capacity on major transatlantic routes fell roughly 70% per year, 3 years running. Between 2000 and 2002, global telecom stocks lost more than $2 trillion of market value. WorldCom filed the largest bankruptcy in United States history to that point. Global Crossing followed. But here is why the analogy is useful rather than just gloomy, and it cuts both ways. The fiber was not wasted. That dark glass became the physical backbone of the cloud a decade later. The asset survived. The balance sheets that financed it did not. Now the difference that matters. Fiber, once buried, is good for decades, Deflation destroyed the carriers while the glass held its value. Accelerators do not work like that. They depreciate on a schedule measured in a handful of years, and the model running on them can be obsoleted by a better one in months. So the AI version of this story runs the price collapse and the asset aging at the same time. That is the structural question, and I am not going to pretend to know the answer. On the other side of the ledger sits demand. Versal's gateway shows token volume up 29% in a single month. Cheaper tokens are pulling more tokens. Whether that pull is fast enough is the whole argument. So what do you actually watch from here? 3 things, and the first one has a date on it. August 31st. Anthropic's introductory pricing on Claude Sonnet 5 expires, and the rate steps up from $2 and $10 to $3 and $15 on September 1st. That is a scheduled price increase landing in the middle of a price war published months in advance. Whether it holds is the cleanest test we will get of whether there is a floor. Second, does Sol move? OpenAI deliberately left the frontier tier untouched. If the flagship gets cut, the war has reached the top of the stack, and the margin cushion at the high end is thinner than assumed. Third, watch next month's gateway index. Open-weight share went 11% to 29% in 3 months. A third of all enterprise tokens is the next round number. And here is the thought I want to leave you with. For 2 years, the argument about whether this industry is overbuilt has been fought with numbers that nobody outside the companies can verify: private valuations, unaudited run rates, commitments spread across 8 years. The price of a token is not like that. It is published, it is compared line by every engineer with a billing dashboard, and it cannot be spun. Last Thursday, that number fell 80% on one tier, while the company's own disclosed cost savings were 20%. Whatever else is true about this moment, the industry has started competing on the one axis where nobody can hide. Keep watching the meter. That is the whole story. If this is the kind of breakdown you want more of, subscribe. We do this every day, and we show our sources. See you tomorrow. That was our deep dive on the token price war. Everything in this video came from primary sources or named reporting. OpenAI's own pricing post, Anthropic's published rate card, the Versal AI Gateway Production Index, Epic AI's inference price research, the Microsoft earnings call transcript, Meta's quarterly results, and market data pulled live on July 30th. Nothing here was investment advice, and where the evidence ran out, we said so. If we got something wrong, tell us in the comments, and we will correct it on air. This has been AI Daily. Subscribe, and we will see you tomorrow.